Hello and welcome back to another edition of the Lippers Fund Flows Insight. My name is Matthew Lemieux. Again, we're going to be looking at weekly fund flows for mutual funds and ETFs for the week ended March 6th. So basically now we're 2 months into the new year. We just finished our first week of March. And really, I think investors continue to see optimism in the markets. You know, we didn't have as much of a pop in the equity markets in February. But if you look at the year-to-date numbers from January to February, most of the equity markets are up roughly about 6%. And I think that was really coming on off of some continued good news in the economy, specifically employment. And we got some new numbers today, and I'll talk about that in a little bit. But also, we saw an upward revision of GDP from fourth quarter of last year, and we got some good news early in the month from China that their export numbers were greater than expected. So overall, I think investors felt pretty good through February. We did have that pesky little issue of sequestration on March 1st, but I think as investors looked to the market to see if there was any general reaction in a negative or positive way, they really kind of just didn't react. But overall, I think that added to the optimism, meaning that another policy issue wasn't going to really hurt any of the movement in the market. And after that, this week especially, we saw 3 consecutive days where the Dow hit its all-time highs. So again, optimism in the markets. We're seeing some strength in stocks, as well as we're seeing some good economic numbers. So let's see really how this translated into fund flows for this week. If we look at our macro groups, we can see once again that the big pariah for this group was money market funds. The reason I say that because if you include all of the funds overall in the conventional fund business, we saw about $6.3 billion in outflows. If you exclude money market, that number changes pretty heavily to $6.6 billion in inflows. And really, it was on the shoulders of equity funds, $3.2 billion into equity, and also $3.5 billion into taxable bond funds. So they continued to be a good place for people to put money. Muni funds were really kind of the outset this week. We saw actual outflows of just about $100 million for that group. So again, the big story so far this year has been equity mutual fund flows. We're 9 weeks into the new year, and we've seen 9 consecutive weeks of inflows into this group. If we look at the breakout, we see that domestic equities for this week brought in about $800 million and non-domestic about $2.4 billion. Non-domestic, once again, was really bolstered by interest in emerging market products, about $1 billion into emerging market funds. But if you look at the year-to-date numbers, it's not as big of a discrepancy as we've seen this week. Actually, if you look at domestic year-to-date, we've seen about $26 billion in inflows, and for non-domestic, about $3.3 billion. So again, more money going to our non-domestic, but still a lot of strength and a lot of interest for equity investors for U.S. stock-specific funds. So let's add on top of that some ETFs, because we have seen some disconnects in previous weeks between mutual funds and ETFs on the equity side. We actually saw $2.5 billion going to equity ETFs. You combine that with mutual funds, we had about 5.7 total, and this is the strongest week of inflows combined for those two in the last 4. So again, a good sign, and we continue to see strength going in there. Within the equity ETF side, the story really this week was SPY, $3.2 billion. In previous weeks, if you'll remember, we've seen a lot of outflows from this group, and we think a lot of institutional sellers. It looks like people are coming back in, feeling confident, seeing that maybe the market has some room to run. $3.2 billion to SPY. One of the surprises, though, on the ETF side, we did see outflows from emerging market equity funds, about $1.1 billion out of EEM. And if you combine the outflows from ETFs with the inflows from mutual funds, it was basically flat. So that was somewhat of a surprise. We looked at some charts and we saw that overall it probably isn't any kind of signal, because investors have continued to be strong investors into equity emerging market products. Since the end of 2008, it's just been a steady increase regardless of what the market does. People are looking for those looking for exposure to those new growth areas within the global markets. So let's go on to our taxable bond fund group. Again, I said $3.5 billion this week, a little bit stronger than we've seen past weeks. This is the 18th consecutive weeks into taxable bond mutual funds, and this is the largest we've seen since the end of January. What has been a little bit different than traditionally what we've seen over the last year is that investors are really going towards what we call bank loan, leveraged loan, or loan participation funds. Basically, these are floating rate funds. We saw about $1.1 billion go into this group again this week, and year to date about $10.8 billion. And I think the significance here is that there is a little bit of concern in the market about rising interest rates, and bank loan products are seen as a good area, not just to get yield, but also since they're based on floating rate paper, that it kind of gives you some of that protection if interest rates start to creep back up. We also saw interest in international and global debt, about $381 million, and this was really split between the broader global income classification as well as investors still feeling comfortable about putting some money to work in emerging market debt, local currency specific products. And then the last one that I will bring up is corporate high yield, because we have seen a little bit of aversion to corporate high yield, about $223 million going in this week. It's the first in 3 weeks. And we also see a little bit of movement on the ETF side for that as well. So let's jump right into it and look at taxable bond ETFs. This week we saw about $1.7 billion going into this group. So combined about $5.2 billion for taxable bond funds, mutual funds, and ETFs. So a very strong week. And again, if you look at it, we see that high yield products were really a place that investors started to feel comfortable going back to. High yield ETFs brought about $597 million for the week. Combine that with mutual funds, we had 820 combined. And so investors, even though I think there was some concerns on pricing issues in the high yield market, I think some investors really felt that, with the optimism and the gains in the equity side, that they kind of felt that they could come back into the high yield market a little bit. So let's go to the third group, which is going to be municipal debt funds. Again, this was a little bit of a difference in what we've seen, even though we've seen some slowing in interest in this group. But this week we saw about $100 million going out of municipal debt funds. This is the first in 10 weeks. Really, at this point, it's kind of hard to say where this movement is coming from. Again, there has been some general slowing in this group. We know that in the past where there were some concerns, investors were kind of flocking to the muni group, especially towards the end of the year. We saw some mixed views because of tax concerns and things like that. So it may just be that investors are feeling more comfortable kind of going away from muni, more into higher risk products, whether it's fixed income or equity. So this week, about $100 million. If you look at the breakout, it was about $80 million out of national muni. And I put high yield muni up there because it was interesting. It was almost exactly a wash. Net flows were basically zero. On to the fourth and last group is going to be money market funds. We saw actually a good week of inflows last week, and I think a part of that was really kind of just small concerns on sequestration. A lot of people really, even to this point, don't know what the long-term effects of that are going to be. But this week we saw money again coming out of money market funds and being put to work elsewhere in the market, $12.9 billion. If you look at the split out between the two, it is somewhat surprising because institutional really led the charge, $13.6 billion out, while retail investors only took out about $710 million. But in the right direction for the risk side, investors taking money out of money market funds, going towards riskier products. So really, what are we going to be looking for going forward? I mentioned at the beginning that some of the through February, and actually through most of the beginning of the year, we have kind of seen that employment numbers, even though they weren't huge gains, they were going in the right direction. But today we had non-farm payroll numbers come out, about 236,000 jobs added, which was much higher than the expected, and it dropped the unemployment rate to 7.7%. So again, a number that puts us into the right direction, keeps optimism in the market. The other thing I think that a lot of investors might be happy about is beyond the sequestration, there was also an issue towards the end of March on whether the Congress was going to be able to fund the government. We've seen a couple bills go through the House already to extend that funding through September. So it would be good to kind of, even though it's still kicking the can down the road, not to have to worry about that hurdle for some time and giving the market the ability to run without that added concern. If you'd like to take a deeper dive into the numbers that we looked at today, you can really visit our website. It's www.lipperusfundflows.com. Or again, you can join us next week as we go through the numbers and see how investors are reacting to the market news. Once again, my name is Matthew Lemieux, and thank you for joining us at Lipper's Fund Flows Insight Desk.